Well, if we don't have a splash of liquidity soon, I see Bitcoin drifting a little bit lower, maybe, and then grinding sideways between 80 and 100,000 for a little bit until
Yeah.
we do see some clear liquidity added to the system, which I do expect to come next year. And when that does happen, I expect us to reach new highs again. I would not be surprised whatsoever to see Bitcoin at 150 or $180,000 next year. Do I expect it? It's hard to expect anything in Bitcoin. But what I do expect is more liquidity, which means I expect Bitcoin to catch back up. And rather than having a steep drawdown in the markets of 30, 40, 50%, I would see if there's a hiccup in the markets, they're going to come with fire trucks if there's anything more than a hiccup.
Bitcoin's fate is no longer tied to the halving cycle. Its future now moves in lockstep with the global tide of liquidity. James Lavish, a former hedge fund manager and macro analyst, delivers a sharp breakdown of why Bitcoin's structural bull market remains intact despite recent volatility. His analysis centers on a powerful set of tailwinds that have fundamentally reshaped Bitcoin's market environment: the rise of spot ETFs, the introduction of ETF options, a more crypto-aligned U.S. administration, emerging stablecoin regulations, and the shift from SAB 121 to SAB 122, allowing banks to custody Bitcoin and build collateralized financial products. These developments, combined with the record-setting growth of BlackRock's IBIT ETF, illustrate how deeply Bitcoin has integrated into mainstream financial infrastructure. Lavish emphasizes that Bitcoin's drift from $60,000 to over $100,000 was a logical repricing driven by these structural advances. The recent pullback, he argues, stems primarily from global liquidity contraction across major central banks. In this framework, Bitcoin's former four-year halving cycle carries little influence. Monetary expansion and contraction now dictate market direction. He highlights declining U.S. bank reserves, now below $3 trillion, as a key signal that the Federal Reserve will soon be forced to halt QT and begin adding liquidity, effectively engaging in quiet QE. If liquidity remains tight, Bitcoin may consolidate between $80,000 and $100,000. Once liquidity expands, Lavish expects the next major leg higher, with targets between $150,000 and $180,000 as policymakers intervene aggressively at the first sign of market stress. If insights like these help you stay ahead of the market, don't forget to drop a comment, share the analysis, and subscribe for more sharp Bitcoin updates.
I don't think we ever got out of a structural bull market for Bitcoin because we have so many things that are going forward and so many tailwinds that we didn't have prior to this. We have so many tailwinds that have developed over the last 2 years between the ETFs, options on the ETFs, a favorable administration now for crypto and Bitcoin. You've got stablecoin legislation. You've got other legislation coming online. You've got the choke point 2.0, which we thought was kind of dead. We'll talk about that. But, that repeal of SAB 121 now became SAB 122, and banks are able to custody Bitcoin and create collateralized products around it. That's a big deal. These are all like big structural issues. You had the ETFs. The IBIT ETF was the fastest asset gathering ETF in the history of ETFs. And so, it gathered, I think, $50 billion in just over a year, which is just incredible. So since then, we had this new administration. You saw Bitcoin get repriced from 60 some odd thousand up to over 100,000. And then it has been grinding sideways ever since. And since that time, this summer, we've had a sharp sell-off here in the fall. And I'll attribute most of that sell-off to liquidity drying up or contracting, global liquidity contracting. And, so the question is, are we still in a 4-year cycle for Bitcoin, or is that dead? And my answer, which you and I have talked about before, is I think that the 4-year cycle is dead, that we're now in a liquidity cycle. So are we still in an expanding liquidity cycle, global liquidity overall? where you're going to have a little bit of movement in between, but the long-term global liquidity cycle is more like, I'd say, somewhere around 6 years, 7 years, which puts us into next year until that starts to really contract again meaningfully. But right now, it's just like this interim contraction, and Bitcoin has been pricing that in and showing everybody that that's happening across the world, whether it's ECB or it's the UK or it's Japan or it's the Fed itself, or it's the Treasury and the Fed, which we can talk about further, or it's just the Bank of China that's not expanding as much as people had hoped or expected. So all of those things have kind of played into Bitcoin here, and being the tip of the risk asset kind of spear, which unfortunately is just the way it's being treated still. Bitcoin's being sold off, and it's telling you that the liquidity has been drying up. So, but that doesn't mean that's going to continue into next year or through next year. I think that we do get an expansion of liquidity, and I think we're going to get it soon. The other indication is, and this is the structural part that is meaningful, is that bank reserves are low. They're down below the point at which the Fed feels very comfortable with the 10 or 12% of GDP or of the total bank assets. Now, the bank reserves have fallen below $3 trillion, which brings them below that level. They're still considered ample, but they're declining to the point where it gets the Fed nervous. Back in 2019, that level was somewhere around 7.5%. So we're at 9 some odd percent right now. If it continues to contract, which they expect it to naturally, then that's going to be an issue, which gets us to what the Fed said last month at their meeting and at the press conference. Powell said they recognize that bank reserves are getting to a level that they have to stop QT, and they're going to have to add to liquidity eventually. Not right away, but they're expecting to rather than later. Now that gets everybody on Twitter and in our investing universe fighting about, is that QE or is it not QE? Well, in my mind, if they're adding liquidity to the system, it's QE. That's literally just the definition of adding liquidity to the system. They can say that it's short term, that it's not meaningful, but if you're adding 20, 30, $50 billion of liquidity to the system every single month, that's still adding liquidity. It's not taking it away. It's the opposite of QT. And so now the only question that we're asking for Bitcoin and in this cycle, and your question is, are we done? Is that it? Is the bull market over for Bitcoin in this cycle? And my answer is, I don't think we're any longer in a 4-year cycle. We're no longer in the 4-year cycle, and we are in a liquidity cycle.
The surge of Bitcoin treasury companies is redefining how corporations capture value in a world of accelerating currency debasement. James Lavish reveals that Bitcoin treasury companies have rapidly become one of the most significant strategic developments of the current market cycle, reshaping how corporations interact with digital assets. Companies such as MicroStrategy, Metaplanet, C21, and Strive Asset Management have adopted a model built on borrowing in a debasing fiat environment and converting that capital into Bitcoin using various financial instruments. Some rely on convertible debt, while others issue equity, but the most impactful structure has been perpetual preferred equity, pioneered by MicroStrategy, which enables Bitcoin accumulation without repayment obligations. Strive employed a similar structure, though Lavish emphasizes that only firms with sufficient balance sheet strength can execute this approach effectively. James Lavish reveals that the excitement surrounding these treasury strategies created a surge of demand last spring and summer, as Bitcoin pushed into the $115,000 to $120,000 range. Investors piled into these stocks without analyzing their fundamentals, inflating valuations beyond reason. He underscores MNAV, comparing a company's market cap to the value of its Bitcoin holdings, as the essential metric for evaluating these firms. Some traded at extreme multiples of 5x, 8x, even 18x MNAV, despite minimal Bitcoin exposure. This disconnect fueled frustration, particularly as hedge funds secured PIPE allocations near fair value M&AV while public prices soared. As those overheated valuations have now unwound and locked-up shares are entering the market, the sector is returning to more rational pricing. Let's get back to the interview.
I think that there is a tremendous use case for these companies. And that's long term, Scott. So just to back up a little bit, for maybe listeners who when you said treasury, they're wondering what you're talking about. You're talking about the Bitcoin treasury companies, and so things like MicroStrategy, that is the one that started all of it, Michael Saylor. And then you had MetaPlanet, and you've got CEP21 with Jack Mallers, and Strive Asset Management. I'm on that board. But there are a handful here, Scott, that I think that are going to continue to grow, and they will thrive in this. Here's the thing, though. When these started coming out last spring and into the summer, there was so much enthusiasm around that because it was basically an arbitrage of the capital markets. They were, you're using dollars you're using a debasing currency to go borrow and buy Bitcoin with in the capital markets. Some of the companies use convertible debt to do it. Some of them just issued equity, and then you started getting into MicroStrategy forged a path of using preferred equity, which is it's perpetual debt that doesn't have to be paid back, and that's the strongest way to use your balance sheet to buy Bitcoin. And then Strive, we did the same thing. We floated a perpetual preferred as well. Not everybody can do that. So let's move back a little bit. Let's move back one step. You had a feeding frenzy. A ton of these companies come out, and it was euphoric. Bitcoin was at all-time highs in the 115 to 120 range, and people were buying these things left and right, and they didn't really understand what they were buying at the price they were buying it. And there's been a lot of anger on social media about this. And the truth is, they were just buying at levels that just made no sense. So what do I mean by that? Well, when you look at these companies, you've got the most basic measure of all these companies is their MNAV. And that's the market capitalization of the entire company over the amount of Bitcoin that they own, the market cap of the Bitcoin they own. Okay, so, and that's called the MNAV. And if they're trading above that, and you have the most basic measure is just using the fully diluted common shares to get to the market capitalization of the company over the amount of Bitcoin they own, the dollars worth of Bitcoin they own. You have to take it a step further, and you really should be using enterprise value. So you should be using their debt as well. If the debt can be converted to equity, you should convert it to equity first. But those are the kinds of measures. That's the basic measure. So if you're trading at 1, that means that your stock is trading at the value of the Bitcoin. If trading above that, that means that your stock is trading above the value of the Bitcoin, meaning that the investors expect that you'll be able to get more Bitcoin on your balance sheet in the future. So they're buying the bet that you're going to be able to get more Bitcoin per share on the balance sheet in the future. And so that's what that MNAV is. So the issue is these MNAVs got out of control. If you look at some of these got up to, 5, 6, 8, 12, 15, 18 times MNAV, and it was insane. And so
some of them didn't even own Bitcoin yet.
And we were watching this. And so here's where people got really frustrated. Being a hedge fund, and so my hedge fund, the Bitcoin Opportunity Fund, we had access to some of these opportunities, being big buyers of them. We had access to them prior to the float of the public equity in it. So it's called a PIPE, where we would buy these shares privately off exchange, and then we would be locked up and wait until they came to market. Meanwhile, these things were trading in the market and we had no access to it. We just watched them. And so, but we were buying them at close to 1 MNAV, maybe a little bit above or a little bit below, depending on the situation. And so that made people pretty angry. But now flash forward to the future where, we're just getting our shares in the last number of weeks and these things completely collapsed.
The current Bitcoin market illustrates a shift from traditional cycle-based investing toward liquidity-driven dynamics, where monetary policy and institutional strategies play a central role in price discovery. Structural tailwinds, including ETFs, regulatory clarity, and bank custody solutions, have strengthened the asset's integration into mainstream financial markets, supporting its resilience even amid short-term pullbacks. Corporate adoption through Bitcoin treasury companies demonstrates a sophisticated use of balance sheet management, leveraging instruments like perpetual preferred equity to accumulate digital assets efficiently. Market valuations, previously distorted by speculative enthusiasm and extreme MNAV multiples, are now normalizing, reflecting more rational pricing aligned with underlying Bitcoin holdings. Liquidity remains the key determinant of near-term movements, suggesting that as central banks respond to declining reserves, the combination of monetary expansion and strategic corporate accumulation is likely to drive the next significant upward phase, potentially setting the stage for renewed all-time highs. Could the next phase of Bitcoin's rally be driven more by liquidity and institutional strategies than by traditional halving cycles? Stay informed on Bitcoin's next moves. Comment your thoughts, share this analysis, and subscribe for more market insights.